Picture a household pulling in $240,000 a year. Two professional salaries, two cars with monthly notes totaling $1,900, a mortgage at 6.8% interest on a $400,000 home, a federal tax burden sitting at roughly 32% effective rate, state tax taking another 6, FICA pulling 7.65 off the top before they ever see a dollar. They have a savings account earning 4.2% while inflation in their actual spending categories, food, insurance, childcare, housing maintenance, is running closer to 7.5% in real cost of living terms. Their financial planner told them to max the 401k. Their mortgage broker told them building equity is the same as building wealth. Their HR department auto-enrolled them into a benefits package that costs them $460 a month in premiums for coverage with a $6,000 deductible. Every box checked, every societal instruction followed, and yet at the end of each month, after the automatic transfers, the auto debits, the recurring subscriptions they barely remember authorizing, they are left with between $800 and $1,200 of discretionary margin on a $240,000 gross income. That is a capital retention rate of less than 0.5%. Not because they are reckless, not because they are irresponsible, because they are sitting at the wrong end of a pipeline they were never told existed. That pipeline has a name. Economists call it the Cantillon Effect. And once you understand the mechanics of how it operates, you will never look at a paycheck, a price tag, or a savings account the same way again. The reality they never teach you in school is that a salary is not a wealth builder. It is an engineered extraction tool. It is the mechanism by which your labor, your time, your compounding human capital gets converted into taxable gross income, then systematically routed through a series of institutional filters, each one designed to capture value before it ever solidifies into a real asset on your personal balance sheet. The Cantillon Effect is the economic principle, first articulated by Richard Cantillon in the early 18th century, that describes precisely how new money injected into an economy does not land evenly across all participants. It lands first, it lands closest to the source, and it inflates asset prices before it inflates wages. By the time that newly created money reaches the average salaried household in the form of a modest cost of living raise, the price of every asset that household might have purchased with that raise has already risen to absorb the new liquidity. The raise arrives after the inflation. The asset appreciation occurs before the wage adjustment. This is not accidental. This is the mechanical architecture of a system that was designed, either by intention or by structural inertia, to transfer purchasing power from the wage-earning class to the asset-holding class in every single cycle of credit expansion. Let us trace the pipeline exactly. When the Federal Reserve lowers its benchmark rate or engages in quantitative easing, it does not send checks to American families. It purchases Treasury securities and mortgage-backed securities from primary dealer banks. As of the most recent balance sheet cycle, the Federal Reserve's asset holdings have swelled to levels exceeding $8 trillion over the course of post-2008 and post-2020 expansions combined. The primary dealer banks, which include the largest commercial banking institutions in the country, receive this liquidity directly. They do not hold it as reserves earning nothing. They deploy it. They extend credit to private equity firms at rates far below what any consumer or small business can access. They provide margin lending to institutional investors. They participate in leveraged buyout financing that acquires cash-flowing real assets, apartment complexes, industrial facilities, logistics infrastructure, medical office buildings, at a cost of capital that the average high-income earner cannot replicate because the average high-income earner is not inside the pipeline. They are outside it, downstream from it, waiting for the water pressure to arrive after it has already irrigated the fields of the asset class. Here is the math of the interception. A private equity firm with strong institutional relationships accesses credit at a spread of roughly 100 to 150 basis points above the federal funds rate during an easing cycle. When the Fed funds rate sits at 50 basis points, these institutions are borrowing at 1.5 to 2% annually. They take that capital and acquire a multifamily residential portfolio with a net operating income yield of 5.5%. The spread between their cost of capital and their asset yield is 3.5 to 4%, captured on hundreds of millions of dollars of leveraged assets. That spread represents the Cantillon premium. It is the mathematical advantage of proximity to the source of new money creation. Now watch what happens when that same liquidity expansion pushes rental prices up by 11% over the following 18 months as more dollars chase the same housing supply. The institutional holder captures that rental increase as income growth on an asset they acquired at a sub 2% cost of capital. Meanwhile, the household earning $240,000 receives a 4% raise, which on a nominal basis sounds favorable, but which on a real basis, adjusted for 7.5% cost of living inflation in their actual spending categories, represents a purchasing power loss of 3.5%. They received more dollars, each dollar bought less, and the gap between their dollar's purchasing power and the institutional investor's asset appreciation widened in a single cycle. This is the wealth leak that no financial planner on a commission-based fee structure will ever quantify for you, because doing so would require them to explain why the products they are selling you are downstream mechanisms, not upstream access points. Your 401k contribution, tax-advantaged as it is, flows into mutual fund structures managed by large asset management firms who charge expense ratios, who execute trades through institutional brokerages, who generate spread revenue on every transaction, who lend your shares as collateral in securities lending programs and keep the majority of that lending revenue. You are inside the system, but you are not at the source. You are several intermediary layers removed from where the actual capital velocity advantage exists. Let us define capital velocity precisely, because this concept is the central mechanical difference between wealth accumulation and wealth stagnation. Capital velocity is the rate at which a unit of capital generates a subsequent economic return before it exits your personal financial ecosystem. A dollar that you earn, pay income tax on, deposit into a savings account earning 4% nominal while inflation runs higher, and then withdraw to purchase a depreciating consumer good has a capital velocity approaching zero. That dollar entered your ecosystem, was taxed on entry, lost purchasing power during storage, and exited permanently upon consumption. Its velocity within your personal wealth loop was essentially a single-use pass-through. Compare that to the capital velocity structure of an institutional asset engineer. A dollar of equity capital is pledged as collateral for leveraged debt at 2 to 3 times its face value. That levered capital acquires an income-producing asset. The asset generates cash flow. That cash flow services the debt and produces residual income. The residual income is reinvested into additional equity positions, which are again pledged as collateral, which again support additional leverage. The original dollar has now been put to work at a multiplied rate, generating compounding returns across multiple asset layers simultaneously, and it has never exited the ecosystem. It has never become a consumer purchase. It has never been reduced to a single-use transaction. It is circulating inside a closed capital loop with velocity, generating income at each revolution. Now here's the question I want you to sit with for a moment, because this is where the practical architecture of your own system starts to take shape. If you are currently earning a high income but retaining less than 2% of it as deployable capital at the end of each month, what is your personal capital velocity? Drop your thoughts in the comments. Tell me where your money is actually going when you trace it line by line. because most high-income earners who do this exercise for the first time discover that between 40 and 48% of their gross income is routed through tax structures before they ever make a single financial decision. Then another 12 to 18% is routed through fixed debt obligations, auto loans, mortgages, student loan residuals, credit facility minimums. Then another 8 to 14% flows into consumption categories that generate no asset return whatsoever. Insurance premiums that ensure lifestyle but build no equity. Subscriptions. Dining. Travel financed on points. Programs that are, at their structural core, interest rate arbitrage products designed to extract merchant fees and carry balances from consumers who overspend to chase rewards. By the time you add the tax layer, the debt service layer, and the consumption layer, the average household earning $240,000 has between 6 and 9% of gross income available for wealth-building activity. And most of that 6 to 9% is being deployed into downstream financial products rather than upstream asset positions. The tax layer alone deserves a dedicated mathematical dissection because tax extinction is the single largest wealth leak in the salary-based financial architecture, and it is the one most aggressively normalized. Federal effective rate at 32%. State income tax, depending on jurisdiction, ranging from 0 in states like Texas and Florida to 13.3% in California. FICA, which is the combined Social Security and Medicare contribution, at 7.65% on earned income. This is not a marginal rate discussion. This is an effective extraction analysis. On $240,000 of gross household income, you are likely routing between $80,000 and $90,000 annually through various tax structures before you make a single discretionary financial decision, $90,000 per year. Over a 20-year working career at that income level, that is $1.8 million routed through tax systems that provide no compounding return to your personal balance sheet. Now, consider that the institutional asset holder structures income as capital gains, as carried interest, as depreciation recapture deferrals, as qualified opportunity zone investments, as real estate professional designations that allow passive loss offsets against active income. Their effective tax rate on economic gains frequently runs between 0 and 20%, depending on structure, compared to your 39 to 45% combined effective rate on earned income. The gap between those two effective rates, compounded over 20 years on a $240,000 income base, represents a capital differential that mathematically cannot be closed by picking better mutual funds inside a 401k. The structure itself is the problem. The downstream product selection is a secondary consideration. The inflation mechanism compounds this extraction in a way that most salary earners never quantify in real-time terms. When the money supply expands, as it has in every recession response cycle since 2008, assets appreciate before wages adjust. This is the Cantillon pipeline in its most visible form. From March 2020 through the peak of the subsequent asset price cycle, United States residential real estate appreciated by approximately 43% in median price terms nationally. The S&P 500 from its March 2020 low to its subsequent peak appreciated by approximately 114%. Institutional holders of those assets captured that appreciation on leveraged positions, meaning their actual return on equity was a multiple of the percentage gain in the asset itself. A private equity firm that acquired residential rental properties in March and April of 2020 with 30% equity and 70% leverage on assets that subsequently appreciated 43% captured a return on equity of approximately 143% in that same period before accounting for the rental income yield during the holding period. The average wage earner received a pandemic-era stimulus check of $1,200 to $1,400 and a temporary unemployment supplement that has since expired. The asset appreciation from that same liquidity expansion went overwhelmingly to entities that were positioned inside the Cantillon pipeline before the expansion began. This is not a complaint. This is a mechanical observation. The pipeline exists. The question is where you are positioned relative to it. And the answer for most high-income salary earners is that you are positioned at the very end of the pipeline, receiving the diluted, already inflated, fully taxed residual of a credit expansion that has already been arbitraged by every institutional layer above you in the capital stack. The closed system secret, the structure that genuine asset engineers have used to insulate their capital from this extraction architecture, is not a secret in the sense that it is hidden. It is a secret in the sense that it is never presented as an accessible framework to the salary class. Let us make it accessible now with precise mechanical logic. Wealthy asset engineers do not let capital exit their personal ecosystem to become someone else's income. Every dollar that leaves your balance sheet as a consumer purchase becomes someone else's revenue. Every dollar that leaves as a tax payment becomes a governmental allocation decision. Every dollar that leaves as interest becomes a lender's yield. The architecture of closed-loop wealth is built on a single principle: maximize the number of economic events a dollar generates inside your personal financial structure before it exits for consumption. Here is how that architecture is actually built. The first structural layer is entity formation. Not incorporation for its own sake, but strategic entity architecture that changes the tax characterization of income before it becomes taxable. A pass-through entity structure in the right business category can reclassify earned income as business income, making a portion of your gross receipts subject to the qualified business income deduction under current tax code, reducing the effective rate on that portion by up to 20%. A properly structured S-corporation can separate reasonable compensation from distributions, reducing the FICA exposure on the distribution portion. These are not tax evasion strategies. These are tax architecture decisions that the salary-based W-2 earner has no access to by definition. The moment you have entity structure, you have access to a different section of the tax code. The second layer is controlled leverage, not consumer debt, which is leverage against depreciating assets or against future consumption. Controlled leverage means borrowing against appreciating assets to acquire additional appreciating assets, structuring that debt service as a deductible business expense, and ensuring that the yield on the acquired asset exceeds the cost of capital by a margin sufficient to generate positive cash flow after debt service. This is the same arbitrage that institutional investors execute at scale. It is executable at the individual level with residential rental properties, small commercial assets, or notes receivable. The math does not change based on scale. A duplex acquired with 25% equity and a 7% interest rate that generates a net operating income yield of 9% is still executing positive leverage. The spread is still accruing to your balance sheet. The depreciation deduction is still offsetting your taxable income. The asset is still appreciating in an inflationary environment where the Cantillon pipeline is continuously pumping new liquidity into the real estate asset class. You have positioned yourself at a smaller scale inside the same mechanical structure that the institutional investor is running at a larger scale. The third layer is income reclassification. Capital gains rates are structurally lower than ordinary income rates in every relevant tax bracket. The difference between a 37% marginal rate on ordinary income and a 20% rate on long-term capital gains represents a 17 percentage point structural advantage that is available to anyone who holds appreciating assets for longer than 1 year. The strategy is not complexity. The strategy is patience and positioning. Buy assets that appreciate. Hold them longer than 12 months. Harvest the gains at the structurally lower rate. Reinvest the after-tax proceeds into the next asset position. Repeat the cycle. Each revolution of that loop generates compounding returns that are taxed at a structurally lower rate than the income you earned to fund the initial acquisition. Over time, the gap between your asset base and your original salary income widens, and the proportion of your total economic activity that is taxed at favorable rates increases. The fourth layer is the cash flow buffer. This is the operational mechanism that makes the closed loop self-sustaining. Before you can stop trading time for dollars, you need income-producing assets generating enough monthly cash flow to cover your base operating costs without requiring you to liquidate the asset itself. This requires understanding the difference between yield and appreciation. Appreciation builds net worth on paper. Yield builds operational independence in real time. A portfolio of assets generating a combined net yield of 8% annually on a deployed capital base of $300,000 produces $24,000 per year in cash flow. That cash flow, reinvested rather than consumed, expands the capital base. As the capital base grows, the yield grows proportionally. At a $500,000 deployed capital base, the same 8% yield produces $40,000 annually. At $1 million, $80,000. The compounding is mechanical. The math is deterministic. The only variable is how quickly you can accumulate the initial deployed capital base and how effectively you protect it from the four extraction mechanisms: taxes, inflation, consumer debt interest, and consumption leakage. The fifth layer is the interception position. This is where you actually begin to replicate the Cantillon advantage at an individual level. The Cantillon pipeline rewards those who own assets before the inflation arrives. You cannot control when central banks expand credit, but you can ensure that when they do, you own income-producing assets that benefit from the subsequent price appreciation, rather than being a consumer of goods and services whose prices rise in response to that same expansion. This means positioning into real assets, businesses with pricing power, or financial assets with inflation correlation before the next credit expansion cycle. It means reducing your exposure to fixed income instruments that lose real value during inflationary periods and increasing your exposure to assets that benefit from the very dynamic that is simultaneously eroding your purchasing power as a wage earner. The wealthy do not protect themselves from inflation by earning more. They protect themselves from inflation by owning assets that appreciate faster than the rate of currency dilution. That is the Cantillon interception in its most distilled form. Share this video with one person you care about because the middle-class loop is designed to keep them trapped. The high salary creates the illusion of financial security, while the structural architecture of taxes, consumer debt, inflation, and systematic downstream positioning ensures that the capital generated by that salary is continuously routed away from the asset accumulation layer and toward the consumption and extraction layer. Breaking out of that loop is not about earning more inside the same structure. Earning more inside a broken structure produces more throughput through the same extraction filters. The answer is structural redesign, entity architecture that changes your tax position, controlled leverage against appreciating assets that generates cash flow, income reclassification that reduces your effective rate on economic gains, a cash flow buffer that makes your operational independence self-funding, and an interception position that ensures you are an asset holder before the next liquidity expansion rather than a consumer of goods whose prices rise in response to it. The Cantillon pipeline is real. The proximity advantage is real. The mathematics of capital velocity inside a closed wealth loop versus the mathematics of capital velocity inside a salary-based consumption structure are not close. They are not even in the same category. The average household earning $240,000 and retaining less than 1% of it as deployable capital is not facing a behavioral problem. They are facing an architectural problem, and architectural problems require architectural solutions, not motivational speeches about spending less on coffee. The blueprint is laid out here in precise mechanical terms. The execution requires that you stop optimizing inside the existing structure and start redesigning the structure itself. If you want to continue building this system, architecture layer by layer, with the mathematical precision that the wealth engineering community uses but rarely shares publicly, Subscribe to this channel now and join the network that is actively building personal wealth loops outside the consumer extraction pipeline.